Here's a question that has started more arguments than politics and religion combined. What makes you more money, real estate or stocks? And here's the frustrating truth. Most people answer it with feelings. Feelings about their uncle who made a killing flipping houses. Feelings about the crash of 2008. Feelings about how the stock market is rigged. So today, we're throwing feelings out the window. We're doing the actual math. Real numbers. Real returns. And at the end, I'll tell you which one wins, and more importantly, which one is right for you. Stay with me, because the answer is going to surprise you. Let's start with real estate. Say you buy a $250,000 rental property. You put $50,000 down. That's your 20% down payment. You borrow the other $200,000. Now here's where real estate gets powerful: leverage. You only invested $50,000, but you control a $250,000 asset. If that property goes up just 5% in value, that's $12,500 in equity gain. On your $50,000 investment, that's already a 25% return before you collect a single dollar of rent. Now let's talk cash flow. You rent this property for $1,800 per month. After your mortgage, taxes, insurance, and maintenance, you net around $400 per month. That's $4,800 per year, roughly a 9.6% cash-on-cash return on your $50,000. Add appreciation plus cash flow, and in a healthy market, your total return lands between 15 to 25% annually on the money you actually put in. That sounds incredible, and it is. But hold on, because we haven't talked about vacancy months. Repairs, the 2 a.m. The roof is leaking phone calls, property management fees, usually 8 to 10% of rent, and the reality that real estate is illiquid. You can't sell 10% of your house if you need cash fast. So real estate, high ceiling, high involvement. Got it. Let's talk about the stock market math. Now let's look at stocks, specifically the S&P 500, which is the benchmark most investors compare everything to. Over the last 30 years, the S&P 500 has returned an average of 10.7% per year before inflation. After inflation, about 7.5% real returns. So what does that do to our same $50,000? Invested in 1994 and left alone, with dividends reinvested, your $50,000 would be worth roughly $1.1 million today. You did absolutely nothing. No tenants, no repairs, no phone calls at 2 a.m. And here's what stocks have that real estate doesn't. Compounding works automatically. Your dividends buy more shares. Those shares earn more dividends. The snowball rolls itself. Stocks are also liquid. You can sell in seconds. They're diversified. One index fund owns 500 companies. And the minimum investment? You can start with literally $1. But here's the catch. The stock market will drop. It will drop 20%, 30%, sometimes 50%. And the biggest risk with stocks isn't the market, it's you. Most investors panic sell at the bottom and buy back at the top. Studies show the average investor only captures about half of the market's returns because of emotional decisions. Let's line them up head to head. All right, same $50,000. Same 30-year timeline. Let's line them up. Real estate. Stocks, S&P 500. Average annual return, 15 to 20%, leveraged, 10.7%. Hands-on work? Yes. No. Liquidity? Low. High. Starting capital, $30,000 to $50,000 plus. $1. Tax advantages. Strong. Depreciation. Good Roth IRA. Risk. Market plus tenant plus debt. Market volatility. Here's the honest answer. Real estate has a higher ceiling, but only if you manage it well, buy smart, and have the capital to get in. The leverage is a double-edged sword. In a down market, you still owe the mortgage whether your tenant pays or not. Stocks have a lower ceiling, but higher consistency, and the data proves that most people, most of the time, are better served by just buying index funds and leaving them alone. Which one is the real winner? So which one wins? The data says this. The best investors combine both. Use real estate to build equity and cash flow, especially once you have capital and want leverage working for you. Use stocks to build wealth passively, consistently, starting from anywhere. But if you're asking me to pick just one for the average person starting out today, stocks win. Here's why. The biggest wealth killer isn't picking the wrong asset. It's picking the asset you'll abandon when things get hard. Stocks are lower friction, lower capital, and lower stress. You are more likely to stay invested. And that consistency beats a higher ceiling you never actually reach. Real estate wins when you're ready, when you have capital, patience, and the willingness to treat it like a business. The best investment is always the one you understand. You can sustain, and you'll stay committed to. Now I want to hear from you. Are you team real estate or team stocks? Drop it in the comments. I read every single one. If this video helped you, hit that like button. It genuinely helps more people find this content. And if you want more videos like this, covering real strategies with real numbers, subscribe. I put out no BS videos on money tips. And before you go, I put together a free video on what to do when you hit the $10,000 mark. Watch it. I'll see you in the next one.